Welcome to Today Finance at Sketching Finance. I'm James, bringing you the latest market updates and expert analysis. Let's dive in. OpenAI is entering a make or break year, and the numbers are bigger than most investors realize. Here's the nuclear number to start 2026. OpenAI is expected to burn about $17 billion this year. That's not a typo. This is the biggest stress test in AI. Because the question is no longer, is the tech amazing? The question is, can the most famous AI company on Earth survive its own cost structure? When burn ramps this fast, the market stops cheering and starts asking one brutal question. Where is the profit? And if OpenAI can't show a believable path, the repricing won't stay inside OpenAI. It can spread across chips, cloud, big tech, and the AI names inside your retirement account. You might think OpenAI is private, so it doesn't matter. But you're the invisible victim if your portfolio owns the AI supply chain. When a key player struggles, investor confidence shifts, and valuations across the whole theme can compress. In the next 12 minutes, I'll give you a simple investor framework: where the burn comes from, what levers can turn it into profit, and the warning signals you can track before the market hits sell on the entire AI trade. Now let's stop chasing headlines and look at the machine underneath. Here's the hidden mechanism. Classic software gets cheaper per user as it grows. AI can do the opposite. More users can mean more compute. More compute means a bigger bill. So growth is not automatically good news. Training is building the engine. Inference is paying for fuel every single day. Training is expensive once. Inference can be expensive forever. That's why free users can become a leak if monetization doesn't keep up. Markets always do this. First comes excitement, then comes the bill. .com wasn't fake. Many business models were just unprofitable. The winners survived because they proved profits. AI is entering that same moment now. Here's the rule that stays true for years. If costs rise with usage, the company must engineer margins by lowering compute cost per user or raising revenue per user. If it can't, growth becomes a trap. This is where we separate hype from a real money machine. OpenAI's biggest cost is compute: electricity, GPUs, servers, and data centers. Reported figures show computing needs exploding from roughly 200 megawatts in 2023 to about 1.9 gigawatts in 2025. Beginner translation: this isn't software scale, this is industrial scale. At a global scale, AI becomes infrastructure. Infrastructure can be a great business after it's built. The dangerous part is the gap between build costs now and profit later. That gap is what makes 2026 a pressure cooker. To be fair, revenue growth has been stunning, moving from around $1 billion to the low teens, reaching roughly a $20 billion annualized rate by late 2025. That's why markets got excited. But fast revenue doesn't automatically mean profit if the cost engine is also accelerating. The make or break question is simple. Can OpenAI break the chain between revenue and compute cost? If compute cost rises almost 1-for-1 with demand, margins stay weak. If efficiency improves, the business can finally breathe. And if you want more calm, numbers-first breakdowns like this, hit subscribe on Sketching Finance, because we turn scary headlines into simple checklists you can actually use. Case study: AWS. It built a flywheel. More customers created scale. Scale lowered unit cost. Lower cost enabled better prices. Better prices pulled in more customers. That's how infrastructure becomes a money machine. AI is trickier. If more usage just means a bigger compute bill, the flywheel breaks. OpenAI needs a new flywheel: efficiency plus monetization. So growth pushes margins up, not losses up. Quick check: are you getting a little dizzy yet? Good, because this next part decides your money. When top AI models look more similar, customers switch faster. And when switching gets easy, pricing power disappears. More choices usually mean lower prices. That's great for users, but brutal for margins. If OpenAI can't charge a premium, it must win another way: cheaper compute or better monetization. Otherwise, growth just burns more cash. Beginner-friendly truth: OpenAI can lose money just by being popular. If a large share of users are free, every extra prompt costs real money, server time, and electricity without matching revenue. So, usage up can be good for growth, but bad for cash flow. To plug the leak, there are only a few levers. Raise prices and growth may slow. Limit usage and users may leave. Add ads and you risk trust. The skill is choosing the right lever for the right segment: free users, power users, and enterprise. Case study: YouTube. Video streaming is an expensive infrastructure. Ads became the engine that paid the bill. If OpenAI moves toward ads or commerce fees, it's the same logic. Use a model that can support heavy ongoing compute costs. But ads have a cost: trust. If ads feel spammy, people leave. The workable version is useful ads, recommendations that genuinely help. If OpenAI can't do that, ads fix margins but break adoption. Now the real catalyst: funding. If OpenAI raises huge money, tens of billions, even aiming toward 100 billion, the market will ask, what exactly is that cash buying? More compute? Cheaper compute? Less dependence on a supplier? Or just more time to delay the profit question? And if IPO talk increases, pressure intensifies. Public markets don't pay for magic, they pay for margins and cash flow. The moment investors smell burn without a path, sentiment can flip fast. And that's how one company's story becomes a theme-wide repricing. Here's the domino most investors miss. Step 1 isn't the real danger. The danger is step 3. If OpenAI shows stress, worse funding terms, slower growth, or weak monetization, investors start questioning the whole AI narrative. Then multiples compress across the board. And the ripple isn't equal. Chips and cloud can still benefit from compute demand. AI apps can suffer if pricing power collapses. So treat AI as a supply chain, not one trade. That's how you avoid getting blindsided by a theme-level reset. Now the practical part: what to track and how to stay safe. This is the value bomb. Pause and screenshot this. Track 6 signals: burn, runway, revenue trend, gross margin trend, paid user share, and competitive pressure. If burn rises while paid share stalls, warning. If margins improve while the enterprise grows, that's strength. Beginners try to predict, pros monitor. Check these signals weekly. It turns chaos into data. And when you have data, you stop getting emotionally whipsawed by headlines. Position smart. Diversify by role in the AI ecosystem. Chips and cloud may win from rising compute needs. AI apps can win too, but face price pressure if models become commodities. Don't put everything in one basket called AI. Build exposure across the chain. Set simple rules. No leverage. Control position size. Rebalance on schedule. If you like no hype, numbers first breakdowns, subscribe to Sketching Finance, because we sketch complex headlines into practical investor playbooks every week. Let's lock the framework in, and I'll point you to the next video. Quick recap. OpenAI's 2026 test is simple. Burn is massive, competition is tighter, and the only way out is monetization that beats compute costs. Burn, monetize, prove profit. Track the signals, and you'll see the turn before the crowd does. If you want the exact dashboard template for tracking AI business health, subscribe to Sketching Finance and comment OpenAI Dadcast. I'll pin it for you. And next episode, I'll share the AI bubble checklist, 7 red flags that warn you before the market reprices the entire AI theme. Click the next video on screen. I'll see you there.